With up to 100% financing, zero processing fee, up to 72 months repayment. No excuses with Stanbic's vehicle and asset financing. Apply today at stanbicbank.co.ke.
This is me at Stanbic Private Banking. What does it feel like? It's having my own world-class private banker. It's me receiving my World Elite card. It's more than banking. It's investing skillfully. It's planning wisely. It's living joyfully. It's banking easily. It's me walking boldly into my future. Start your journey. Visit www.stanbic.co.ke. Stanbic Bank is regulated by the Central Bank of Kenya. This is me at Stanbic Private Banking. What does it feel like? It's accessing a private airport lounge. It's me having access to offshore banking opportunities. It's more than banking. It's investing skillfully. It's planning wisely. It's living joyfully. It's banking easily. It's me walking boldly into my future. Start your journey. Visit www.stanbic.co.ke. Stanbic Bank is regulated by the Central Bank of Kenya.
With up to 100% financing, zero processing fee, up to 72 months repayment. No excuses with Stanbic's vehicle and asset financing. Apply today at stanbicbank.co.ke. With up to 100% financing, zero processing fee, up to 72 months repayment. No excuses with Stanbic's vehicle and asset financing. Apply today at stanbicbank.co.ke.
This is me at Stanbic Private Banking. What does it feel like? It's having my own world-class private banker. It's me receiving my World Elite card. It's more than banking. It's investing skillfully. It's planning wisely. It's living joyfully. It's banking easily. It's me walking boldly into my future. Start your journey. Visit www.stanbic.co.ke. Stanbic Bank is regulated by the Central Bank of Kenya. This is me at Stanbic Private Banking. What does it feel like? It's living a rich financial legacy for my family. It's more than banking. It's investing skillfully. It's planning wisely. It's living joyfully.
Set? Online?
Sali, zawadi. Shot, yang, yang, shot, yang, 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 shot, yang.
Chong, yang, yang. Yang, yang.
Chọn nhọn 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 nhọn. Chọn nhọn 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 nhọn.
No, chong, yang.
With up to 100% financing, zero processing fee, up to 72 months repayment. No excuses with Stanbic's vehicle and asset financing. Apply today at stanbicbank.co.ke.
Okay. Good morning. The results of Stanbic Holdings. We are broadcasting from our Stanbic offices here in Westlands. With me in the studio is our chairman of the board, Mr. Joseph Muganda. With me is our regional CE, Patrick Muhere. With me is our CE, Dr. Joshua Igara, and our CFVO, Mr. Dennis Musau. Good morning once again. My name is Lillian Onyach. I am the head of brand and marketing for Stanbic Bank Kenya and South Sudan. I will be the moderator of this session today, and I'd like to welcome our investor analysts who are online. I'd like to welcome our media fraternity who are online and are also here in person, who will be conducting the interviews after this session. I'd like to welcome our leadership team who've joined us online. We do have our board members who've joined us online. We have our leadership council who've also joined us online. Ladies and gentlemen, our purpose for this session today is to review the half-year results, provide a context in performance, share with you our strategic outlook, and engage in an open question and answer session. And to walk us through this process and to provide an overview of the period under review, I'd like to welcome our chairman to give us the opening remarks, after which we will have presentations done by our regional CE and our CFVO. We will then have our Chief Value Officer, Financial Value Officer. Sorry for the abbreviations. Lastly, we'll then have the panel that will walk us through the question and answer. So to kick off this session, ladies and gentlemen, and thank you very much for joining us, I just want to confirm that we do have our comment section opened virtually, and please do listen in and share with us. We want to have an engaging session on what we want to share with you today. So without much further ado, let me welcome our chairman of the board, Mr. Joseph Mukenda.
Good morning, everyone. Our esteemed shareholders, investors, and analysts, members of the media, fellow board members, Stanbic leadership team and staff, ladies and gentlemen. It is a privilege to address you today as we reflect on the 2025 half-year results of Stanbic PLC. I'm pleased to highlight the strides we've made and the key milestones achieved amid a continuously evolving macroeconomic and financial environment. Our unwavering commitment to serving our clients has been central to our progress, enabling us to make substantial progress towards achieving our strategic priorities of transforming the client experience, executing with excellence, driving sustainable growth and long-term value for our stakeholders. The global economy has moderated in 2025 with a growth projected at 2.8%, down from 3.3% in 2024. This revision is largely driven by the weaker growth expectations in the United States and China, following increased tariffs and retaliatory measures. Geopolitical tensions in the Middle East remain a key downside risk impacting trade. On a positive note, global headline inflation and international oil prices have remained relatively stable, providing relief to emerging markets. Here in Kenya, the economy expanded by 4.9% in Q1 2025, and the central bank forecast a 5.2% growth rate for the full year. This recovery is supported by easing inflation, a more accommodative monetary policy stance, resilient performance in the service and agriculture sectors, recovering credit extension to the private sector, and stronger export activity. Our bank continues to play a meaningful role in supporting Kenya's economic growth and remains strategically positioned to capitalize on emerging opportunities, reinforcing our role as a trusted partner in driving sustainable growth and long-term value creation for our shareholders and broader stakeholders. Despite a declining interest rate environment, the banking sector remained resilient, maintaining profitability, healthy liquidity, and capital adequacy ratios evident in Q1 2025 industry data. At Stanbic Holdings, our half-year results reflect these macroeconomic and market dynamics. We reported profit after tax of Kenya shilling 6.5 billion, it's a 9% decline compared to the same period in 2024. This is largely impacted by a significant drop in net interest income and a decline in trading revenue on the narrower margins. Our balance sheet closed at Kenya shillings 4.474 billion, 5% below the same period last year. That said, we have seen encouraging signs of strategic momentum. Specifically, we recovered from a 17% profit after tax year-on-year dip in Q1 2025, and also achieved a 4% balance sheet growth from our 2024 year-end position. It's a strong indicator of improving trajectory for the second quarter. In line with these results, I'm pleased to announce that the Board of Directors has approved an interim dividend of Kenya shillings 380 per ordinary share. Yes, I said 380 per ordinary share, being a 107% increase from the Kenya shillings 184 paid as interim dividend in 2024. This demonstrates our ongoing commitment to creating shareholder value while maintaining prudent capital management to support future growth. Whilst the first half of 2025 has presented some headwinds, our long-term fundamentals remain anchored. We are confident in our strategy and investment we are making to future-proof our business. Our focus for the second half of the year remains clear. It's to deepen customer engagement, enhance our digital capabilities, and drive operational efficiency. We are well positioned to seize emerging opportunities within Kenya's vibrant banking landscape and to deliver sustainable value to all our stakeholders. In closing, I want to sincerely thank our shareholders for their continued confidence and support. I also extend my appreciation to our clients for their loyalty, our employees for their dedication, and the board for its strategic guidance. Finally, I would like to thank government and the regulatory bodies for their mutual trust, guidance, and support. Thank you.
Asante sana, Chairman of the Board, Mr. Joe Muganda, walking us through very briefly on the macro overview, giving an indication of the performance, which we will go in more detail shortly, and also providing an outlook in what we expect as a bank to focus on moving forward. He's also said something very interesting and reiterated the dividend payment. He's mentioned it twice. And thank you for that. And I think our shareholders do appreciate that. I'd now like to invite our regional CE, our regional chief executive, Patrick. Mr. Patrick Muhere does not only take care of our Kenya business, but also takes care of our businesses for Standard Bank across the region. Patrick will provide for us a context of what we have achieved in terms of our strategy and also give a focus in a little more detail on what we expect moving forward. Patrick, karibu sana.
Morning, ladies and gentlemen. Thank you for joining us this morning for our half year. I'll go through a little bit of our operating environment. First of all, just to start with who we are. This really lays out the fact that we've got the bank, which is one of the most significant entities that we have. Then we've got the non-banking entities, securities, bank assurance, and then the foundation. At the end of the day, those non-banking entities are actually there to support the ecosystem of the bank. Even though they are significantly less in terms of profitability, we think they create quite a bit of value in terms of interaction with the bank. You'll see at the far end, we added a net 30,000 customers last year, which is quite significant. And when you add our distribution network with 30 branches and 714 agents, we feel that we're very well positioned to serve our clients. Just to touch on the global environment just a little bit, I think you'll all accept that we are navigating a lot of geopolitical dynamics at the moment. You look at the US policy shifts and you try to kind of put your head around what that really means for us in Africa and for Kenya in particular. You look at the tariffs, the trade tariffs. I think one real example would be Lesotho, where there was a significant reliance on exports to the US, and unemployment there has gone up to almost 40% because of the tariff that the US imposed on fabrics, almost to really cripple that industry. So these are real problems. On the foreign aid cuts, we've seen about $1.5 billion cut across the East African region, which has been going into really supporting a lot of vulnerable people in terms of healthcare, AIDS, malaria, typhoid, etc. Now, we cannot continue to have some of those things completely ignored. So the implications are that the governments are going to have to find the funding to make up for that gap. AGOA, etc. So all these things coming together do create a little bit of, should I say, a powder keg for us as we navigate. On the geopolitical tensions, again, around the global supply chains and the weakened growth and inflationary pressures, one of the silver linings, I think, for us in East Africa is the fact that we're very connected and we trade quite a bit amongst each other, 40% of trade amongst the East African countries. And that creates a buffer, and it's a really important buffer for us in terms of supply chains. And we saw this even during COVID. We're able to bounce back a lot quicker than other regions because we don't have the 100% dependency on foreign. We can rely on each other to sort of support each other. Moving on. Again, in terms of the region, this is just to give you a breakdown of what and how important this East African region is, and how resilient it is, and how it continues to become a really important investment destination, not only for financial investors, but even strategic investors. And it's very clear on this chart. You add up the population, if you include DRC and Ethiopia, it's about 500 million. GDPs are roughly 500 billion. And you can see that we're knocking quite heavily in terms of size around getting bigger than South Africa and West Africa. Southern Africa and West Africa, not South Africa. So as a region, if we continue to grow the fastest, because 5 of the fastest growing countries in sub-Saharan Africa are in this region, it's only a matter of time that East Africa is going to be the largest trading bloc in sub-Saharan Africa. And that's significant because with that comes more investment, more FDI, more, should I say, investment thesis, and again, more confidence. And we believe that that stability that we have also shown, which I'll touch on in a minute, in terms of how we've dealt with the instability on the macro side, will also continue to attract investment. Quickly on this slide, again, I won't go through again the GDP growth numbers because they're quite attractive, and I've touched on that already. But you'll see down on the far left, on the bottom left corner, that the central bank rates have started to come down quite significantly. They're all in single digits now. And that just shows you that the monetary policy worked. And the central banks now have a license to continue cutting, because if you look up on the right-hand corner, you'll see that inflation is now under 5%. It's actually 3%-ish for all the countries in East Africa. They all have a 5% inflation targeting monetary policy and have room to cut some more because inflation is significantly lower than their target. So this is all good in terms of bringing stability to the system. Now, it has implications for us, which I'll talk about in a minute, about our business and some of the drivers to our business. But you cannot fault the fact that the central banks and the policymakers have done what we wanted them to do, which is stabilize the shilling, stabilize the rates, bring inflation down, and bring back a little bit of GDP growth by bringing that sort of confidence level. So if we go down to the Kenyan economy, just to touch on a little bit, again, we've seen a lot of significant growth on the GDP, even though Kenya is lagging in terms of the East African growth numbers, which are roughly around 7% if you average it out with Tanzania, Uganda, etc., and Rwanda. However, I think that number is still quite a solid number, the 5.5% projection for 2025. But if you look down at the bottom, this is what I wanted to touch on. That downward trend in rates is really remarkable, and it's welcome because it does reduce pressure on clients. But what it does for our business is that it puts pressure on net interest margins, because all of a sudden we have to basically run faster to stay in the same place because we do not have this sort of uplift in terms of margins. So we're going to have to do a lot of things, and we're starting to do a lot of things to diversify and bulletproof our business so that we're not really highly dependent just on the interest rates. The other point to make is that we've seen a lot of deteriorating credit quality. You'll see that our numbers are significantly lower than the industry. Industry is around 17.9. We're running around 9%. So we've managed credit quite robustly. And I think that we are quite happy with where we are, but we would love to see private sector credit growth come back and bounce back, because there's a little bit of a conundrum there. Rates coming down, but private sector credit growth was negative till this last quarter. And even then, it's an anemic 2%. So we would want to see that number in the high single digits. So we want to see what other policy measures can come into play to help that. Then the last point to make there is also on the stable currency. I mean, it's been unbelievably stable. I mean, if you'd gone to bed in July 2024 and woken up last week, July 2025, you would not believe that the shilling moved from 129.1 to 129.3. It's almost unbelievable that it has absolutely not changed in a 12-month period. So that's a great thing as well. It brings stability. But, you know, banks like a little bit of volatility. So the lack of volatility has really also affected some of our global markets business. Because really, I mean, it's kind of like, you know, your blood pressure doesn't move, doesn't change, which is a good thing, shows you're healthy. But then it doesn't allow you to do anything else. It means that you're not running around, you're not doing any sports or anything. So we're looking for a little bit more volatility in the coming year. And then just to sort of start to wrap up on the operating environment, let me start with the headwinds, which I've touched on some of them. The sharp decline in rates, the muted volatility. One of the other things that's really becoming apparent and beginning to kind of work its way in the system is the pending government bills. I believe I've had a number as big as 1 trillion. We don't know what that number is, but the fact that it's affecting a lot of small businesses which do not have a lot of staying power. So if they're not paid and they have bills outstanding for 90, 120 days, it does start to affect. And you can see that it's really playing out in the credit quality of the portfolio of the industry. So subdued credit appetite because of the high default rates. And then, of course, I talked about the protection policies. So those are the headwinds. Now, on the more positive side, we've got well-anchored inflation. We've got recovering private sector credit growth, although not recovering fast enough. Diaspora remittances remain quite solid, and they're bringing in some of that stability as well on the exchange rate. And then also the exchange rate has boosted volumes. And also a resumption of South Sudan oil exports, which is kind of helping us out a little bit. And then moving on to our strategy, just to remind everybody, the 3 pillars which are strategic priorities are really to transform client experience, execute with excellence, and then we believe that that eventually leads to sustainable growth and value. So our success pillars are, we believe that you need happy customers, happy employees, then you manage risk, you can't leave the back door open, and then you have to be operationally excellent, so make sure that you're always either digitizing or removing friction out of the system, and ultimately that brings to the great financial outcome. So in the middle there in the bar is really what we're intending to achieve in our 24 to 26 strategy. 14 or 15% revenue growth CAGR, NPS scores of plus 50, a cost-income ratio around 42%. We want to get below a 9% NPL ratio and ultimately get back to a mid-20s ROE. So that's kind of, this is our, in one chart, what sort of our drivers are. Now, I'll just touch on those 3 pillars very quickly and give you an update on what we're doing. We're doing lots on everything, but just to give you an update on the client piece. So what we did a lot of work on the sovereign support. As you know, we did a lot of advisory work on refining the Eurobond transaction. We're trying to build our middle market business, which has gone up 4 times in helping out with schemes. We obviously have a very good CIB business, corporate client, etc., but we are trying to build DNA in the middle market. We also launched an asset management business, which has grown quite significantly, has 4.3 billion assets under management. We did a lot of enterprise support. This is really our SME initiative. We disbursed, I believe, 16.5 billion in the first half of 2025. We're now the 5th largest SME bank in Kenya. And of course, on the employee engagement, we continue to develop and invest in our people. So that's on our client and employee engagement pillar. Moving on to our executing with excellence. These are a couple of things that we've done. We have launched some enhancements to our mobile banking platform, which, by the way, is now, I think if you go to the Play Store, is really, really highly rated. And we are continuing to do a lot of things in the background to refresh them. We've done some physical infrastructure revamps around Galleria Mall, Nanyuki, Westgate, and also we're doing some work here in the Chiromo head office. On the risk management, again, we're among the best in the industry. And then lastly, a really exciting piece, we're trying to really roll out and really leverage AI and robotics. And we've successfully delivered or deployed 17 bots across our network. So we'll continue to use this technology as it helps us help and develop efficiency. Then the last one, which is sustainable growth value. These are kind of what I would call our true north pillars. So we always look at what we're doing and how does that really tie back into the aspirations of the nation, what's driving, and what is the, the policymakers and the government, what are they intending to do? So infrastructure is one, climate change and mitigation, job creation and particularly enterprise growth, and then ultimately financial inclusion. So we make sure that we also measure ourselves against these things because ultimately we're trying to build a sustainable business. Yes, a profitable one, but sustainable. So we always have to go back and really compare to the true north to make sure that we are. And so here are some of the things that we've done. 30,000 trees were planted. We did 4.5 billion green building loan. On the loan book, 8% of our loan book is in agri sector, 95 billion trade loans. On financial inclusion, we've trained about 6,000 individuals on financial fitness, 200 new homeowners, etc. So I won't go into all that detail, but needless to say, we are doing a lot on that front. I believe I will leave it at that, and we will take questions a little bit later. Thank you so much. I hope that gives you a little bit of perspective on what we're doing. Thank you.
Thank you, Patrick. It does give context to how we are running our business. Before I invite Bwana Dennis Musau, as CFVO, I just want to reiterate a couple of things that our regional CE, Mr. Patrick, has touched on. He's walked us through the region and the resilient markets that we are seeing. He's also touched on the tailwinds and the headwinds that we have faced as an organization in this country. Very interesting in terms of the three pillars and what we have achieved. I think for me, what stands out is the business that we're trying to grow in the middle market, the support and the advisory work that we still continue to do in supporting the government in the sovereign support. Within the operational space, the work we've done within the mobile banking, AI and our risk management, and lastly, our sustainability agenda, being the 5th largest bank in terms of MSME, is something to really to be proud of. But there's something that he said. He said, as a business, we need to run faster. And I'd like to invite Mr. Dennis Musau to really tell us, the chairman earlier on talked about 17%, and then he shared that this number has now come down to 9%. What are the details of this? And Musau will really share with us from a business how the house comes together, how we really, really break it down. And then when we get to the question and answer section, I think we will now ask Patrick to go into a little more detail on these pillars. And Daktari is also in the room, who will also join us to really go into more detail on what we expect to see in the second half. So, Mr. Musau, please share with us the numbers in more detail.
Thank you. Thank you very much. Thank you, Chairman, for setting the context and the big announcement. Thank you, Patrick. I've never quite thought of the exchange rate in terms of blood pressure. So that's a new one. Thank you for that. And really looking forward to unpacking the numbers to our media and our investors. Thank you very much for joining us. I guess the context that has been set starts with what the background in which our results are set and the scene in which they are set can be described in many ways, but I guess these two graphs kind of explain it. The first part, if you look at that blue line, it shows the FX volatility that we saw starting early 23, hitting high 160s or early 160s in early 2024, and then coming down sharply in Q1, Q2 2024, and then the flat line that we have operated with, kind of the 129 that Patrick spoke to. There are opportunities that come with that, but there are challenges, as Patrick explained, that when you don't have volatility, and I'll show you the industry performance as a result of that graph. But that's one of the scenes in which the results are set. The second scene is you look at the interest rates, again, a relatively slower but gradual increase all the way to the middle of last year. And then that dotted line comes down steadily. That impacts our lending rates. That also impacts the cost of funding. Again, the results of the bank and the industry around now are set in that scene. Now, let's reflect on the first quarter, industry P&L. This is the banking industry P&L in the first quarter. You can see net interest income ticked up 11%, largely on account of reduced cost of funding. So flat on the top line, and a bit of that is because of hedging in terms of earnings protection initiatives. NIR, non-interest or non-funded income, came down 10%. You can see the impact of the line that Patrick was speaking about on FX income. FX income in the industry came down 53% in the first quarter, just Q1 this year against Q1 last year. So from a earnings perspective, the industry increased earnings by 4% in the first quarter of this year. Costs went up 9%, a fair balance between staff costs and other costs or other operating costs. Impairment remained largely flat, actually came down about 6% in the quarter, and is at industry level. And that leads you to almost a flat performance in terms of profitability in the industry in the first quarter. You can almost draw a line that to the balance sheet sizes that you see at the bottom. Customer loans flat year on year, or Q1 this year vis-a-vis Q1 2024, and customer deposits growing by a paltry 4%. There are some statistics to pick on the right. There is improved credit risk or cost of risk in terms of credit loss ratio. Cost to income ratios on account of lower earnings in the industry. Cost to income ratio ticked up from 44.7% to close to 47%. Now, when you unpack the bank's results, you will see a similar trend, largely on account of earnings. So coming closer to the bank, and this is our balance sheet as Stanbic Holdings, which the chairman kind of covered on a very high level. Our total assets at 474 billion came down about 5% compared to the first quarter of last year. But you can see that middle column shows that we closed the year at 455. So there's a slight uptick from 455 to 474, about a 4% tick up in the first half of the year, which demonstrates some level of recovery, and you can trace that to the loans and advances to customers, which went up from 230 billion to 233 billion. Still very low, but mirroring the private sector credit growth that we have seen. In fact, I'm reminded that last year when we had this conversation, private sector credit growth was 4.3%, and we were complaining that it was low. Little did we know that we would hit some negatives in the intervening period and actually get back to 2%, which we are calling recovery. So there's some slow recovery there. It's showing, but we do hope that we can see a lot more of that. On the deposit side, again, a contraction of about 5.5% from 349 billion to 330 billion. But again, watch that middle column. We closed the year at 318 billion. So we've shown a 4% increase in our customer deposits in the first 6 months. Looking at the ratios on the right, very happy to report slow but steady growth on total assets and customer liabilities. Very happy to report a sub 10% NPL ratio at 9.5, slightly above the 9.44 that we reported at the end of at the same point in the year last year. Looking to continue watching that number towards, if you remember Patrick's slide on our strategic target, we want to get that number to below 9%. Liquidity and capital remain very, very resilient, and therefore, just reflecting on the dividend payout, you can see, despite that dividend payout, we remain sufficiently capitalized. This is the income statement. The challenges on growth on the balance sheet, the challenges posed by falling rates and the impact on NII, on pricing, net interest margins, show in that NII. You can see NII, net interest income, came down about 6%. Non-interest revenue remained resilient. If I open up that NII just a little bit, gross interest income came down 24%. Now that's massive, because if you think about a balance sheet that is steady, we cut rates, and I actually saw there's an analysis in today's Business Daily which shows Stanbic reduced the average lending rate by about 500 basis points year on year. That is actually what is showing in that NII, as we have responded to our customers' request for lower pricing, as we responded to public demand for cheaper credit. That's showing in that NII number. We do hope to grow as a result of that reduction in pricing. We can grow our volumes and therefore recover that 6% and show some growth. NIR, fantastic, holding steady despite the challenges in FX. If I actually break up that number, it's got two broad numbers. Very happy that our strategy on being transaction heavy and transaction led, diversifying on our revenue is starting to pay off. We saw our fee and commissions increase by 9% in the intervening period, in this period, H1 against H1 last year. But trading revenue came down 7%. That is how it balances out to a 1% growth. Total income came down 3.3%. Operating expenses increased 16%. I know that is a little bit higher than we would have wanted, but I'll just remind us that when we spoke at this point last year, our operating expenses had actually come down by 7%. So if you look at 2023 H1 costs, we reported 8.7 billion, then we came down to 8.1. Why? Because of some of the currency correction and credit note that we got from lower accruals because of an adjusted currency in H1 last year. So if you draw a line between 8.7 to 9.4 over a 24-month period, it doesn't look as steep. If anything, if I adjust for that base, our growth in our costs is about 4.5%, which is kind of in line with inflation plus a bit of investments, because we're getting more people, we're serving our clients better, we're investing in digital platforms. Credit impairment, 26% down year on year, something that we are very proud of. We continue to manage credit very well, credit risk very well. Yes, times have been hard. Our customers have been impacted. We've continuously engaged and navigated these difficulties with our customers, and hence the credit impairment. And our CLR, you'll see our credit loss ratio is at 1.2%, which is within the target that we want to achieve. And in fact, one of our 2026 targets is already met in that regard. And therefore, profit after tax comes to 6.5 billion, which is 9.3%. Lillian, you asked, what's the transition? Yes, Q1 was very difficult. It was a slow start to the year. In January, private sector credit growth was negative 2.9%. So that caused massive contractions on balance sheets, and rates were coming down quite significantly. FX activity was muted. So that is what explains the recovery from a negative 17% in the first quarter to the negative 9%. I do hope when we speak to the investors next, we will have brought down that negative a lot more significantly. Our cost-to-income ratio, remember I did show that there was a 200 plus basis points increase in the industry cost-to-income ratio. Ours has gone up slightly higher than that to 48.1%. Again, if you reflect on the points around earnings and the fact that some of the benefits on costs that we had last year haven't repeated, that explains that movement. Just looking at our prudentials, our capital remains sufficient. Very happy with our liquidity ratios and our ability to serve our customers with demand at any time. And our funding remains properly, the mix between customer deposits, interbank, and borrowings is steady, plus our equity supply of financing. The last slide shows how the house comes together. Very, very happy with the performance from our subsidiaries, our embedded businesses in Stanbic Bank Assurance, which has gone up nearly 50% year on year, cheering that team to continue delivering and continue accelerating. Very good growth shown by the SBG Securities Limited business, which has gone up nearly 60%. We've seen great rebound on the equities and the bonds activity in the NSE, and we do continue to gain market share there and are very happy to see that business. That is also the business that houses our asset management business, which was non-existent when we spoke this time last year. That business has been in existence for about 9 months, and it's shown great progress and contribution to SBG Securities. Again, to our investors, this speaks to our strategy of continuing to diversify our offerings to our clients and to increase our surface area of earnings. The bank, of course, is where the challenge was, and I've spoken to that. So the bank went backwards 10%, but that's the number that was 17% in the first quarter of the year, and we do hope that we can bring that to below single digits and positive. And that brings the house to 9% down year on year, a result that we are very proud of in the circumstances and looking forward to continue showing resilience and growth and serving our customers. Thank you very much. Lillian, I'll hand over back to you. Thank you.
Thank you, Bwana Musau. Unpacking the numbers, ladies and gentlemen, I just want to remind you that we do have our questions lines open, so please do go in and share with us. We're getting into the engaging part of this session. Musau has just given us a breakdown of how we arrive at the 6.5 and really how these numbers come together, touching on the assets, touching on the customer loans, and also really giving us the confidence around the risk management space. And so just to transition to the next part, we will now have our panel discussion. And in this panel discussion, we will have our regional CE, who did touch on the environment. We will have our CE, Dr. Joshua Igara. We will have our CFVO, who can now touch in any more detail, any questions, any area that you feel was not touched in terms of our numbers. So we will play a very short advert just to transition us into the question, and we will have our panel seated here. So just give us a minute to get right back as we interlude, a very small interlude as we transition. Thank you, ladies and gentlemen.
We're all in pursuit of it. It will get you up early and charged up. It will make you put in the hours. It will drive you and push you forward. It's ambition. The ambition to become a success story. The ambition to leave more than just a memory, but a lasting legacy. To support your ambition, we enable you to bank easily by offering you a world-class trusted advisor with extensive experience in banking and investment. With power in your hands, you can bank on the go with ease 24/7. As you continue to pursue your ambition, live joyfully with your exclusive MasterCard World Elite card. Enjoy fast-tracked service at an airport lounge with your +1. Enjoy both local and international golf club benefits and peace of mind with travel inconvenience insurance and medical travel. Go further in your ambition and invest skillfully. Get value for money with in-country and offshore investment opportunities so you can leave a rich financial legacy for your loved ones. Ambition thrives on wise planning to protect your health, your income, and what matters most, your family, to ensure that they're covered. This is where ambition meets affluence. It's more than banking. It's banking easily. It's living joyfully. It's investing skillfully. It's planning wisely. It's Stanbic Bank Private Banking, the #1 private bank.
Fali, zawadi. Shot, yum, yum, shot, yum, 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 shot,
정영영.
정영영영영영 정영영영영
No, 정영영영영영영.
With up to 100% financing, zero processing fee, up to 72 months repayment. No excuses with Stanbic's vehicle and asset financing. Apply today at stanbicbank.co.ke.
Welcome back. Just testing. Welcome back, ladies and gentlemen. We are now ready to move to the question and answer session. This is the financial results of Stanbic Holdings, half-year results, and I do have my panel here. I had done the introductions earlier. We have Dennis Musawa, CFO. We do have our regional CE, Patrick Muhere, and we do have Dr. Joshua Igara, our CE. To get us started, I have a couple of questions that have come through, and I do have our head of investor relations who will feed me. So if you see me looking at my phone, will feed me with more questions as they come through online. To start us off, I'll go with Patrick. So the question that I have for you, Patrick, you talked about going to bed July 2024 and waking up July 2025, and that number, I think most of us do not realize how that number has not significantly changed. So how are the macroeconomic factors, the interest rates, the inflation, the FX, volatility, impacting the bank's profitability? So that's a question that has come through. With the drop in interest rates and drying up in FX volatility, where do you see opportunities to grow revenue going forward?
Thank you for that, Lillian. Like I said, I mean, if you think about the stability that has been brought by the macros being dealt, I think what we need to do now is to effectively get out there with the clients and start engaging with clients and really begin to show them that if you think through from a historical perspective where we are on interest rates, this is a pretty good time to be borrowing. It's a pretty good time to be investing in new projects because you're going to generate a much better return. So it is really about engaging. It's also about engaging, and if you're an exporter or if you're an importer, just to show them that there's a bit of a hedge now in terms of your balance sheet as well. So it's to really kind of communicate the benefits of the stability that we've seen and then try to stimulate growth from our client base. So I think that's one of the things that we need to do. The second thing we need to do is just to think out of the box. I think at the end of the day, banks do more than lending. We need to start activating some other parts of our DNA, which is the non-interest revenue. So what can we do on that front? Can we go out there and start structuring transactions around renewable energy, some of the things I talked about around sustainability? Can we accelerate the growth in those areas by becoming a bit more innovative in our structures? So I think it's going to take a little bit of homework because this is not a very normal environment. In order for us to remain competitive and profitable, we're going to have to start to do a few things a little bit differently. And I think we're cut out for it. We've already started to do that work. Thanks.
Thank you. Thank you, Patrick. I'll now move to Dr. Joshua, the question is, with the proposed changes by the Central Bank of Kenya to the risk-based pricing, how is this going to affect your pricing of the customers moving forward? And how is it going to affect your earnings?
Lillian, these are an exciting questions because it's been very consultative, I would say, in the industry. Everybody seems to really have a different view. And I was happy that so many people, both in Kenya and globally, gave their views. My answer would be simple. That there was enough time, the right time to make a review of the risk-based pricing model. Remember, it came in 2019. So we've had enough time to be able to reflect on. We're very much aligned. And because it's consultative, it's actually work between the industry, led by the Kenya Bankers Association and the industry and central bank. So ultimately, it's a framework to transition into how do you say, what is the risk-based pricing for a client? How do you actually put a margin in terms of the reference rate? It will be there's more convergence in the market. I don't think it's an issue about, it will be much easier for clients to have transparent pricing for themselves. And most likely, every single benchmark rate, you'll be able to compare between different industry players, different products. And therefore, it's an exciting moment, something we've been recommending for. So it's not about affecting our business, but it does help our clients make it easier for them to interpret what is the reference rate, which, as you see, the central bank published. What is the premium rate, which is a component of many factors we're putting in place. And Lillian, I will finalize that it's a range. Depending on where you are on your risk premium, where you are as a risk client, where you are in terms of your context, then in terms of the pricing you're going to be able to have. So it will also be simpler. The current model was much more complex. So we are looking forward for it to coming in place, most likely in the second half of the year.
Thank you, Dr. I think what I like of what you've said is it was a consultative process. Yeah, so the industry was involved. And thank you for that, Dr. I'll now move to Musau. Dennis, you shared the results. Your operating expenses have shot up 16% above prior year, possibly eroding your profitability. What are the key drivers to this growth, and what measures have you put in place to arrest this increase?
So we arrest growth if it is bad. I think investing in our people, investing in channels that serve our clients, investing in improving risk management and protecting value that is in our ecosystem on behalf of our customers is not bad. So we don't want to arrest that. What we want to do is to ensure that we optimize the investments that we've made. And the link there is, how do we extract a lot more earnings, a lot more return from the investments that we've made? Last year we went through an upgrade of our core banking system. It has become a lot more faster, a lot more stable in serving our customers. How do we translate that into earnings? Last year we went and revamped our mobile app, which the chief executive spoke to, that is receiving almost 5 stars on the app stores. How do we ensure it is utilized by our customers because they actually asked for it? So we are not in a. I know in a previous session we said we do not think we can prosper by saving costs. We can only prosper by making more earnings or converting the investments that we've made into earnings.
Thank you, Dennis. I think what you've shared with us is it's the right investment. So yes, the operating expenses are up, but it's really in the right place. Daktari, you are the leader of the organization in Kenya and South Sudan. Your profitability year on year is down. And your balance sheet has equally contracted. What's your outlook?
So let me just first explain that this is, there is no surprise. So I don't worry at all. We have responded, and Lillian, it's important that when you look at halves, you look at quarters as well.
Okay.
We have a significant credit dislocation last year when credit was growing at a minus growth. We haven't seen that in a very, very long time. Okay. So as the industry follows actions from the regulator, from the central bank. And so as rates came down, what you've seen is our interest rates have also come down. The natural impact is going to be our revenue is going to come down. Just a normal response. So the monetary policy transmission framework comes through how banks respond on interest rates. So it's good that I explain to our investors that this is a natural response. Banks don't act out of tandem with the central bank actions. So that's important to respond. So our interest rates are down 5 to 6%. And this is what everybody is expecting. Every single person I meet on the street saying, when are they going to adjust the interest rates? So that's one aspect. Patrick also mentioned earlier that we've seen resilience and stability on our exchange rate. Now, what is important, Lillian, is activity for our clients in the last 6 months. Actual day-to-day work for clients is up 25%, 24, 25%. I mean, that's dramatic in an environment of resilience. So that's one pocket of growth. You're seeing more volumes. If you look at quarter to quarter, from December to June, you're seeing a 4-5% growth in assets. So pockets of growth, we are seeing that in manufacturing largely. We are seeing that in agriculture. We're seeing part of that coming into construction. Yeah. And you've seen the government bringing in an impetus of paying pending bills. So we're actually in an exciting position in quarter 2 compared to quarter 1. And I've been in the industry for long enough to see the cycles over time. So we delivered a stronger, Chairman mentioned about the quarter 2 results now, which is better than a quarter 1 results. And so we anticipate credit. So what you need in our economy is to be able to have more actions that drive growth. Whether it's a pending bill payment you're going to have, higher revenue raised by sovereign, that's what you need generally, if you compare us across the region. So we are a resilient economy. So I don't worry about, can we build growth? Yes, we are seeing that. And I get excited. Today we are largest lender on affordable housing in the last 6 months of the year. Yeah. So, and that for me shows you the granular actions on what drives the economy. So our business is well poised to take advantage on the growth opportunities. I mean, I must say that as 4.7% of GDP, credit always grows at 2 to 3 times of that. So if it was 4.7%, we should be growing at 13, 14%. But credit is 2%. So that dislocation actually is perhaps why we're also pushing a different pricing model as an industry to bring in more impetus. So across all elements, our largest clients, if we look at our CIB businesses or wholesale clients, we see a lot of demand in the market. If you look at our SME clients as well, we see a lot of activity. I mean, and what you're going to do more is, if you look at our risk, our loss ratio, Dennis spoke about our NPL at 9%, we have enough headroom to continue to take on much more risk as an organization. Go into a market share game build in the second half of the year. Because we have opportunity, because we do have. There is no point, at 9%, nobody in the industry can act a better play in the industry than us in this second half. So I'm quite excited about where we stand. And our economy naturally will lift itself up with stronger growth momentum, as I've mentioned, and that's a chance for our shareholders in the second half.
Dr. Ari, thank you for reminding us that let's look at this on a quarter by quarter, and you're seeing opportunity as we move into the next quarter. Patrick, there is a question for you. I'm reminded I had to go back and just reconfirm the dividend number. And so this question, as you represent one of our biggest shareholders, is you have declared a very good interim dividend shared by the chairman, which is good for the shareholder. But aren't you starving the business funds to facilitate growth? How does this performance affect the full year dividend outlook?
Thanks for that question. I think in coming up with the dividend, we look at a couple of things. One is the balance sheet. How much capital do we have? How much capital do we need for our growth? And we do a really robust analysis around that. We've been talking, and Joshua's been talking about private sector credit growth, etc. There's absolutely no need to keep excess capital if you don't need it. So what we've actually done, and if you look at our capital CAR ratios, they're significantly higher than what the regulatory minimums are. And within that, we've built in buffers for growth, we've built in buffers for any unforeseen risks, and then on top of that, we've also built in a buffer to effectively, if we get some sort of unprecedented growth, how do we manage that? And then anything in excess of that, we pay back to the shareholders. Because it doesn't make sense to have excess capital when you don't need it. One, it depresses your return on equity. And secondly, we always have access to capital if we need it. And if we do ever have a problem, if we ever run into a crisis, we can cut back on the dividend. But at this point in time, based on the data that we have, we felt very comfortable that this is the right dividend to pay out to our shareholders. We will make another estimation as we go through the second half of the year, and then at that point we'll make another evaluation on what the final dividend should be to smooth out what again using the same sort of principles of excess capital versus so the balance sheet matters and opportunity. Thank you.
Thank you, Patrick. Let me now move on to Dennis. Dennis, you continue to print a very healthy asset quality in an environment where the market continues to witness a surge in NPLs. What has contributed to maintaining such a good quality book?
By asset quality, I am interpreting this to mean NPL ratio.
Yes.
Which admittedly is at half where the industry is. So we're at 9.5. Industry has been around 17%. I'll say it's three things. You achieve good credit quality if you exercise your muscle on writing good credit, and therefore the relationships that we have with our clients, how we do the risk analysis at the inception of the lending arrangement is very important. The second principle is managing and monitoring the credit through the cycle. If you borrowed a mortgage in 2015, between 2015 and today, you have seen 2 elections, you have seen COVID, you have seen floods and drought that we have not seen before, you've seen locusts, and you've seen tariffs. Through that period, we stay with the client, we talk to the client, we help them navigate any bumps on the road, and support them through ensuring that their objectives are met. And the third principle is, how do you exercise your recovery muscle when things go wrong? And it's the recovery not to kick people out of their houses, but it's recovery in looking for win-win solutions, because for the most part, people who borrow want to pay. They want to make an earning or return out of the business they're investing in, and they want to pay, they pay the bank. When things turn, how we relate to those customers because of our long-standing relationships, and we've got very good client relationship scores. Our clients keep on telling us that we relate with them very well. When things go south, how we talk to them helps us achieve that that good credit quality. It is something that we want to continue focusing on. It is something. These are muscles that we continue exercising and going to the gym every day to ensure that they're working.
Thank you. Yes, yes.
Let me just add that you have to triangulate the question of the credit quality depending on the sectors of the economy. It's important that industry, because if you look at your wholesale clients, your SME clients and personal banking clients, actually where you fall in that triangle determines on your pocket. So our 9.7 is low, but ideally is actually quite on top on where the industry should be. Because if you are a bank that is largely on one different segment and you are largely dealing with your main consumer market, your NPL will be different. So it's important that we don't use ours only. The industry is in a different point of a triangle. We seem to be in a perfect spot because we have more larger wholesale clients as our bank, and then we have high personal wealth clients that we have. So we're in a very good space. And it can explain also the industry, because the industry has got different kind of measure points. So I see it as a continuum where we are. And actually, Lillian, if you pick up banks that are in the same posture like us, we're generally in the same neighborhood in terms of 9%.
Very good transition, and thank you for providing the context in terms of industry and client profile. Dr. Ari, this is a question to you. Second year of the strategy, and the question is, second year into your strategy, how are you tracking on the milestones that you set? Where are the areas that you think you are winning? Which are the areas that you think you are lagging? And are you likely to realize the full milestones that you had set for one Stanbic strategy?
So it's a very good question, and I'm always reminded around when individuals look at strategy as a very short-term journey. Even when I told me today that the global shift and the global tariffs that are coming in from advanced economies into African markets, like the new tariffs Patrick talked about in Lesotho today, I mean, it does change completely. So we have to realize that it's always going to be an agile model how you plan and refocus your ambitions. So we're not changing our medium-term plan. Patrick mentioned about our revenue growth, today 14 to 16%. We have had some shocks, and those shocks is what we are navigating. Our NPS score at 50, that we're remaining with that kind of ambition. We are at 28, we believe we'll get there. Our cost-income ratio at 42, so we're a bit higher now at 47, 48, we'll get it done. If you think about our NPL ratio, we're just there, and then our ROE at mid double digits of 23, 25%. So I don't have a concern that we should be able to achieve those ambitions in due time, in 2026. So the headwinds, naturally markets are shifted, which is what we anticipate, and we continue to calibrate. What we anticipate that has been a biggest challenge for us is what I called as credit dislocation last year and this year. But I'm confident that the actions between industry, and we've seen this kind of lens before. What I like about the Kenyans is the dynamism and resilience. We've exercised that muscle before. There's a time credit was growing at 2%, correct? And Kenya's credit was growing at 16%. So once we get that back, Lillian, I think we're sharpening ourselves to be able to take opportunities in the markets where we see. And that's what I would say for our strategy. So nothing that we're changing. Okay. We are building momentum. We've had some shocks, which we're navigating, and that is the nature of building strategy for our business.
So what you're telling us is the strategy is long-term. We will build the momentum on the things that we are lagging behind, but you're confident that we will deliver the strategy that we set out. Musau, back to you. Was the drop in deposits driven by specific sectors or segments? Dr. Ari has touched on, different sectors that we play in or different industries. So was this drop in deposits driven by a specific sector or segment?
Yeah, thank you. Thank you for that question. That is an incisive question getting into the balance sheet. So allow me to give some color. It is not a specific sector. If you remember having this conversation last year, balance sheets were anemic on funding, and cost of funding was quite high. Yields were very high. Professional depositors, or those that deposit for purposes of yield, were asking for quite high returns on their deposits. And you would remember government yields at the time were also very high. So competition for funding was very stiff. When we closed a half year last year, out of the 355 billion in deposits that we had, 90 billion were fixed deposits, right? As we were in that clamor for those deposits. If you look at the drop from 355 to about 330, you're talking about 25 billion, but fixed deposits came down from 90 billion to 50 billion. So here go, we've actually grown our current assets and savings, current liabilities and savings liabilities, as the cost of funding and the competition for high yielding deposits has come down. So it's not one sector driven, it's the profile of deposits and also reprofiling our balance sheet. Again, you take deposits for purposes of lending. So again, on the asset side, we've seen balance sheets not growing on the asset side, and therefore we've chosen to let go of some of the expensive funding that we had.
There's a follow-up question, and I'm not sure whether, Dr. you want to take this or Edwin, Dennis, you'll take this. And the question is around credit tightening. Do you think that the decline that you've seen in your customer loans is a result of you've tightened a bit too much our credit process?
So actually, maybe that's not how to look into it. If you look at where we were in December, so quarter 4, quarter 1, and quarter 2, our loan growth, right, it's modest, but it's a 4% growth, correct? Industry growth is at 2%. And that's just a direct answer to the question.
Dr. Let's keep to you in this particular question. And it's a question about trends in consumer behavior. What trends are you seeing in consumer behavior?
So, I mean, Kenya lives at if you think about our technology affinity, areas of artificial intelligence that we see a lot of dynamism on actually from our people, it's quite exciting for what you've seen in the last. And our people are there's a lot of optimism in how we see our consumers across many parts of the economy. So whether it's techies, whether it's on education, on healthcare, on fashions, on their own spending, our asset management business, which has seen significant growth in asset under management. So there's a lot of momentum we continue to see across all segments, whether it's your Gen Z, so it's going to be your medium income, your startup, your executive, your high net worth. We see that a lot of work going on. So for me, it's exciting. And our investment a year ago in our mobile banking app that was refreshed. I remember when we started, we got a rating of 2 out of 5 on the app stores a year ago. And we've seen that go all the way to 4.8, 4.9, which is a very high score. So that's an exciting to be able to see. What has been the only downside we've seen is that initially, because of the difficulties clients are facing on there today, the overall purchasing power has been affected in the last year. So that's what you see being translated in lower credit growth in our markets. But I can guarantee you that we're seeing that. What excites me, Lillian, is you have to look at this from a quarter-to-quarter basis. When you get mini shocks, what you need to look at is what is the green shoots to recover from the shocks to build an economy and grow credit in our markets. When you see liabilities growing up in our markets, we achieved more than 100,000 clients on our mobile banking app this year in June. So we see the activity and the interconnectivity on what we do. So for me, I see the enthusiasm, I see the optimism from our clients, and actually as credit moves, and inflation is very, very well anchored today from what you've seen. So from the monetary side, we believe that the central bank has taken the greatest actions to be able to roadmap the economy into a position of growth.
Dr. You've touched on last year you invested, and I think Musao touched on the growth on operating expenses of 16. You talked about the mobile platform, launching it last year, 2%, 2-star. And I think Patrick touched on how amazing it is right now if you go to the App Store in terms of the rating. But we did have a recent system breakdown. And the question is, you recently experienced a system breakdown. What assurance are you giving the customers that the money is safe and the systems are stable and that this problem will not recur soon?
So first, I must acknowledge that it was a difficult day, when we had, it was a couple of hours. But I'm one person to say that when you use technology and systems, you do have areas when you have downtime. That's the nature of technology. And I've seen that across the world, not just for our own institution. But we put in place very strong measures as an organization. We run, the banking solution we run as a bank is used by more than 1,000 banks globally. So it's not just our own issue. It's proven. It's very strong. And what you're doing is we're working with our partners who are well known. They are one of the top 2 anyway across the world. So we do have a very good platform. And we haven't had a downtime like this for a long time. When it does happen, what the board and management have done is to be able to have a continuity framework on how we continue running businesses, how we build. And Lillian, what we're really pushing for is to have what you call as a quadruple 9, a 99.99% reliability. Today we are at 999. Now that 0.001%, it may look a little one, but it's exactly how the incident happened in that moment. But the recovery was good. We don't anticipate, the situations that we faced. But I'm fair to question that, downtimes happen. The question is, how do we recover them and make sure our clients have the activities going on? And it's not just on T24. Now, this was not what you call as a P1 incident, which is an incident that stops all operations. Our operations were in there, but we are not able to have the core banking system running. And I have worked with the partner for more than 15 years, Lillian, so I am confident that they are well established across the world.
Yes, you want to add on?
Yeah, can I just add that, just as an assurance that at no point during that system glitch was there, risk to our customer data or customer funds. So that is one area that is guarded very, very strongly. So the system may blip, and we will do our best to bring it up back up. But the integrity of our customer data and the integrity of the value that they've given us is always safe.
Thank you. I think that is very important to give that assurance. I can see one last question, and I'll position this question to Patrick. As part of the long-term strategy for the bank, and I guess for the holdings, how is Stanbic building internal capacity? I don't know whether you'll take that question or you'll ask Dr. to also chip in, so you can.
Internal capacity in terms of people?
I believe this is a people question.
Okay.
Yeah.
Okay. That is, I think I touched on that on one of my slides, that we really believe that you cannot have happy customers without having happy employees. So one of the things that we do is invest significantly in learning hours and in upskilling our people. And it's something that we provide digitally, sometimes in small groups, or even if it requires to fly them all the way to Johannesburg to go for some specialized training. So it's something that we're very deliberate about in building that capability. And then in addition to that is that we have very, very detailed discussions around aspirations for those people and where they want to go, where they want to be in 2 years, 3 years, in 5 years. And we track that. We track that quite significantly. And also, remember, we're in 22 countries. In fact, I think I was speaking to Joshua right now. We've got about 40, thereabouts, 30 to 40 Kenyans that we've already exported to other parts of the group to develop expertise, and hopefully they'll come back. So it's something that is part of our DNA. I don't think that, we believe that people are the biggest asset that we have. And if we can't continue to have the best people in the market, we can't compete. So it's something that clearly is on my scorecard and Joshua's scorecard. So it's a very important thing. Yeah.
Terry, do you want to add something?
Yes, Leon, I love that we run a program called Why Wait? And you saw it running across our social media, and we had close to 10 million views on Why Wait? So many people want to say, can we connect and partner with Stanbic to build that organization? I'm not talking about talent, correct? So it just tells you that there's, of all the benchmark, our brand has a chance of affinity to invite a lot of people who want to come and join us because we're doing something that is great. Patrick mentioned that on the continent, we're the #1 institution to work for on the continent, ranked by Forbes. correct? And then internally from the board, a lot of work has happened. We actually this year until June, 60% of all our promotions have been internal. 60%. We still haven't gone, the board's aspiration is to reach that level to 80%. So that tells you that even just building is not enough. We have to promote them, get them an opportunity. So if you look at 10 people, 6 of them have been built, developed, trained, promoted within the organization, ignoring what Patrick said about some outside the organizations. So I will benchmark, and I've been a captain of industry for long, that our environment for our employees to work and thrive is perhaps best within the context of the Kenyan market than anywhere else you can find in the financial sector.
Thank you very much. I will now bring this to a close. I want to thank all our stakeholders who joined us online, the leadership team that joined us, our board members, our leadership council, my colleagues who joined us online, the media fraternity that joined us online. We'll now get to closing remarks. I'll ask Daktari to please just give us closing remarks. After this, we'll move into interviews with the media fraternity for Daktari and Musau. But before we do that, I'd just like to ask Daktari to please give the closing remarks.
I want to say thank you very much for all of you for joining us this morning on our broadcast. It's been exciting to see, our recovery and our strengthening of our performance in the second quarter. We are building on that strong momentum as we go into quarter 3. Dennis did mention about our aspirations for this year, and Patrick and the chair. So looking forward into connecting with you one again in the next time we do our investor update. Thank you for joining us, and enjoy the rest of your morning.
Asanteni sana. Thank you, everybody. We'll now call this to a close. Thank you.
It is a pleasure to welcome you to the launch of our 2024 Sustainability Report. Africa's population has expanded 5-fold since 1960. We need to build industries and economies that can adequately meet the region's needs while still harnessing our resources responsibly. We have been able to tailor our 4 impact areas: job creation and enterprise growth, climate change mitigation and adaptation, infrastructure development and just energy transition, and financial inclusion.
We've developed solutions, frameworks and platforms to advance economic resilience, climate change adaptation, and inclusive growth. We spurred economic growth by investing in key sectors, and we've supported SMEs, agriculture, and trade. With a clear sustainability agenda and enabling environment, we continue to stay true to our purpose. Kenya is our home. We drive her growth.
We are the most significant bank in the agriculture business, and obviously a lot of work for me is to be able to continue creating more than 5,000 jobs, financing solar, renewable energies. Our ambition is a journey for 1 million trees, working in partnership with the team from Kenya Breweries. Just last year, we had 2 billion shillings of affordable mortgage schemes issued to more than 250 families. And across the digital program that we run very closely with the Microsoft team, over 77,000 youth have been accessed, provided information, trained, building their capabilities to grow their business and create an income.
As a government, we firmly believe that sustainability is a shared responsibility. We are encouraged to see that Stanbic's sustainability agenda aligns so closely to our national priorities, including the bottom-up economic transformation model, the Kenya Vision 2030, and our global commitments under the Sustainable Development Goals, that's the SDGs, and the Paris Agreement on climate change.
What do we do to accelerate sustainable development to ensure we have proper sustainable growth?
For communities, it's about dignity. I have to live well, even for me to think about making money first or building an economy. And then for the private sector, it's about prosperity. And then lastly, for government, it's about creating legacy.
What are the most pressing sustainability expectations that you're seeing, especially for investors and consumers?
The demand for that more transparency with what organizations are doing around the society and the communities that they live in, and then on the governance space.
Today we celebrate 5 years of Stanbic Foundation. The last 5 years would not have been possible without the support of these partners. So for GIZ, it's our 3rd year. And today we want to launch the program that is focused on women employment for the Green Transformation Program.
Today marks not only the launch of the important report, but also the beginning of an exciting new regional partnership. One that aims to strengthen the capacities of women-led businesses in the green sector across Kenya, Tanzania, Uganda, while enhancing their access to finance.
Are we ready for this moment, ladies and gentlemen? There you go, all eyes on the screen. Please press the buzzer now, chief guest.